Hi, and welcome to Futures Discovery on John Lothian News. I'm your host, Cortez Draper, and on this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today, we're delving into the intricate world of agricultural futures, a realm shaped by the rhythm of nature and the pulse of global markets. In this episode, we'll explore the quantitative challenges that traders face in the real world. It's not just about numbers on a screen, it's about the unpredictable nature of weather, critical data and crop reports, and the global dance of trade policies. Let's start with the basics. Seasonality. The timing of planting and harvesting season plays a crucial role in determining supply and demand dynamics. Traders need to be attuned with these natural cycles to make informed decisions about the market. Next, we have the intricacies of rolling contracts. Agricultural futures often require traders to roll contracts due to the nature of crop cycles. It's a strategy that demands careful planning and execution. Other important concepts in the market is the forward curve and cost to carry. The forward curve plays a pivotal role in agricultural futures trading, serving as a crucial indicator for market sentiment, supply and demand dynamics, and potential arbitrage opportunities. The forward curve, which illustrates the relationship between futures contract prices and delivery dates, provides valuable insights into market expectations regarding future prices and storage costs. Analyzing the shape and slope of the forward curve enables traders to assess market sentiment, anticipate changes in supply and demand conditions, and identify trading strategies. Additionally, understanding cost to carry, which encompasses storage costs, interest rates, and dividends, helps traders evaluate the feasibility of carrying positions from one period to another. By considering storage costs and cost to carry, traders are able to assess the profitability of various arbitrage opportunities, such as cash and carry arbitrage and reverse cash and carry arbitrage, and make informed decisions about their trading positions. As we navigate through the agricultural futures landscape, we cannot ignore global dynamics and trade policies that shape these markets. From trade tensions to geopolitical events, external factors have a profound impact on prices. Quantitative traders dive deep into the vast troves of data encompassing price movements, supply and demand dynamics, weather patterns, and geopolitical events. By employing advanced statistical models, technical analysis, and machine learning algorithms, they uncover hidden patterns and trends within the data. At the heart of quantitative trading lies the development of robust mathematical models. These models range from econometric equations to sophisticated machine learning algorithms, enabling traders to make informed decisions based on historical data and market behavior. Successful quantitative traders are always learning and adapting to changing market conditions. They stay updated on the latest research, technological advancements, and regulatory changes to refine their strategies and maintain a competitive edge. Trading in agricultural futures markets demands a blend of analytical prowess, mathematical expertise, technological know-how, and a keen understanding of market dynamics. As we continue our exploration of agricultural futures and delve deeper into how professionals interact with these markets, let's speak to Jack Scoville, the current Vice President of Price Group, who brings over 30 years of experience in agricultural futures. His extensive experience will provide valuable insights as we delve further into the world of agricultural futures. Thank you for joining us today.
Well, pleasure. It's been a fan of John Lothian and John Lothian News for quite a while, so it's very nice to be invited to do this.
Great to hear. That's great to hear. I think you're going to be a great contributor to our episode today on Futures Discovery. What's the significance of agricultural futures and how are they used in industry?
Futures prices for ag markets are derived from essentially from world prices, mostly here in the United States and the Midwest for corn and soybeans, rice down in Arkansas primarily, cotton down in Texas primarily, but really wherever the crop is grown, the farmers and the elevators look to set prices, and it's an indicative price, but one that's very grounded in reality. The fact that there's a delivery mechanism at the end of every contract for 2, 3, 4 weeks, depending, keeps the market related to what's going on in the underlying cash markets. I like to actually view the ag markets as instead of a derivative, I like to say that they set the tone, because really what happens in the futures is going to indicate where the cash price is going, not the other way around. usually the cash price, in financial markets will dictate what happens to the futures. Here, the futures tend to dictate what happens to the cash.
I like that setting the tone for the cash, because this is something that's unusual to maybe, I would assume equity index futures. But for here, in the ag future space, the futures are really setting the tone here. So that's interesting to hear. When I think of ags and agricultural futures, I think of seasonality. I think of a new harvest. I think of there has to be, important seasons for different ag futures. So seasonality as a fundamental aspect of agricultural futures trading, how do professionals incorporate seasonal patterns into their trading strategies? And what role do they play in your decision-making process?
For me, I find them very important. I try to be a buyer at harvest time because that's generally when the lowest prices of the year are going to be made. Try and be a seller at 6 months later when we're starting to run out of certain commodities. And that's usually when we start making high prices. Most users kind of look at it the same way. Farmers are going to still sell a portion of their crop right at harvest. They have to. They run out of storage. They have to let some of it go. They need cash flow money as well. But for the most part, they're going to it's changed. They're storing the crop more, and that has changed the seasonality a little bit. There's still a harvest low, but it might not be quite as deep as it was before because farmers have much better storage capacity on the farm. They don't need to just dump on the market. On the other hand, I think as the buy side has learned about these seasonal patterns, they're more willing to step up to the plate and do more buying at the low times of the year. And you can identify when those are happening. In corn and soybeans, it's generally in the fall when we see our low prices. In soybeans, we have a secondary low in spring when the South American crops are harvested. And South America has become a very important player in the soybeans, and they're becoming a very important player in the corn. But the corn that they sell is a winter crop, which coincides with our summer. So really, they're kind of piling on to the corn. At the same time, they're harvesting their crop. In soybeans, it's kind of the opposite. So you'll see a secondary low in the spring. And those are, I consider, longer term for hedging purposes, especially. I see those as longer term buying opportunities. Beyond that, you're going to have other factors, the total production here in the U.S., around the world, demand prospects here in the U.S., around the world. All these things factor into what the prices are going to do later on, and will dictate how much of a seasonal factor the harvest lows will be. But generally, the way it works is you do have a harvest low, then you're going to have a rally out of that harvest low to some extent. And the trick is to identify what that extent could be.
How do you analyze the forward curve to assess market sentiment and identify potential trading strategies if you use the forward curve?
Primarily an indication of supply and demand. So if you have a tight supply or you've got really strong demand or both, the nearby months are going to be higher than the deferred months. And that's not a very common occurrence. Generally, it's the other way around in the ag space. Generally, there's a cost to carry associated with the markets. And you can calculate what that is. You have interest rate costs, you have just the cost of storing it at the elevator, how much that could be a month, penny, 2 pennies, 3 cents. Then interest rates for holding on to the grain, and some other factors, the cost of insurance of the crop and things like that. These all factor into what the cost of the carry can be, and you can actually calculate that. And those calculations are called full carry. When you see a full carry situation in the futures market, that means that either the demand is bad or there's plenty of supply around, or both. You're less likely to be a real aggressive buyer because you look at it, you say, hey, there's no reason for me to get too terribly long here. There's plenty of grain out there. You tend to go more hand to mouth if you're a user, for example. A lot of times when 1 month, for example, May right now, when that goes off the board or we get into delivery, July will start coming down to meet the May price. and the May will go to where the cash price is, which in soybeans and corn is basically what the cash price is along the Illinois River. That's called convergence. A normal market, you'll see a lot of convergence at these times. You'll see people kind of sticking with the front month to get their purchasing done because they're going to be paying, the cost of carry if they start buying more deferred months. They don't want to pay that. So, they're going to avoid paying anything they have to. So, and understandably so. So they're going to concentrate their purchases on the front month. If we got a situation where the front month is above the futures or above the deferreds, then the paradigm changes a little bit. You're more likely to see people more interested in buying deferreds because they're worried that the prices aren't going to go down the road. They're going to keep on catching up to where the front month is. So they're going to step up their purchases of deferred months as well.
What kind of tools and indicators that you use, on a daily basis, if it's okay with, letting your secrets out a little bit, in your decision-making process, that's maybe, outside of the fundamental stuff?
I do look at the charts very heavily, and there are various charting methods that I can use. I've used primarily a point and figure type system, and which is kind of a congestion and breakout system. And if you get a breakout from a congestion area, you go with it. It also gives you objectives to the upside. You can and then use the daily bar charts kind of the same way. And then increasingly with the volatility that we've seen in the market the last few years, I've noticed that the weekly charts and have become that much more important, especially for objectives for how high or how low prices can go. So I'm going to look at all those factors, and they will, along with the fundamental background that I have in the market. Fundamentals to me are more of a long-term indicator. They're going to tell you where the market's going, but they're not going to give you buy time points, sell points, things like that. That's where the charts tell you all that. So you have to use both. And that's what I try and do on a daily basis. I'll look at the fundamentals, see if they've changed in a significant way. And then I'll analyze the charts and see if they tell me anything I need to be waking my customers up to.
So I want to know global dynamics and trading policies and their impact on agricultural futures. How do you navigate these external factors, and what strategies do you employ to mitigate the impact on your trading activities?
Well, not only do we trade futures, but we trade options. And that's one way to mitigate it. You can certainly hedge off what you're doing. I do use hedges. I do use spreads. When I feel it's appropriate. Not all my customers like options, not all my customers like spreads, but I like them both. And so I will recommend that to them. Whether they take it or not is up to them. But the other thing is really you just have to keep yourself very well informed.
Before we conclude, I want to know, is there any advice for young individuals like myself trying to, navigate the dynamic landscape of agricultural futures and break into the industry? Can you offer any advice to us?
I do think it's a very specialized part of the world. There's the macro markets and things like that. Everybody knows about those. But ag, not so much. And there's so many idiosyncrasies. There's actual production. There's actual demand that you don't see in like stock market indexes or things like that. People actually do use the corn. They actually do use the soybeans. So you have to be very conscious of that. And people produce corn and people produce soybeans. And so you have to be conscious of that. And I think that with that in mind, you have to be able to think about it a little bit differently than you would some financial markets in your career. It's important to know your charts. It's important to know your fundamentals, but it's important to know that you're dealing with economics that a lot of the world doesn't really deal with. As you grow in agricultural futures, be it softs, be it tropical markets, be it grain, you have to be conscious of the fact that you're making some decisions that will have real world impacts on what people's money and people's ability to drink coffee every day, for example, or eat corn fritters every day, or eat a steak every day. I think you have to take your time to understand it. But I think once you do that, then you have a real chance for a really interesting career, because what happens in my world really doesn't happen anywhere else.
I love to hear just the real world importance of ag futures when getting into the space and thinking about the space and the implications that these futures really have and everything around us. And you talk about, it's specialized, there's a lot of moving components, so it takes more than just fundamentals and charts. It takes the economics of things as well. So being a good learner, taking your time and assessing the market was all great feedback from you, Jack. So, we appreciate your time and insights into agricultural futures. Your wealth of experience and expertise has provided a unique and enriching perspective, contributing significantly to our exploration of the dynamic world of financial futures. Thank you for being a part of Futures Discovery.
I'm happy to be here. Thank you.
If you're enjoying the content today on Futures Discovery and want to learn more about derivative markets, be sure to look at other videos on this series and check out Options Discovery, hosted by Esma, to learn more about the space.